We're in the acceleration phase. We're in that phase of the last year of the bull where it goes berserk. And it prices in all the things that have been in its gut all along, knowing they're coming. It starts to see those things develop, like, for instance, the unemployment situation deteriorate, therefore the Fed reverse policy. Gold knew that when it priced it in. So now we're getting to the point where I think you start to go vertical. And you can take all your technical metrics that you're used to looking at, throw them out the window. We're in a new reality right now. The relationship between silver and gold at those times, tail end of those bull markets, accelerates favoring silver to the point where it's almost, it's a joke. It just so outpaces gold by so much. It's, gold's going up and it's going up dynamically, but silver just goes ballistic.
The Federal Reserve announced on Wednesday that it will maintain current interest rates, with plans for only one rate cut this year. This decision follows a significant government inflation report indicating that consumer price pressures are gradually decreasing. However, Fed officials believe this trend is not yet firmly established. In their updated economic forecast, central bank officials said they anticipate inflation to rise later in the year. Initially, the Fed had projected 3 rate cuts for 2024 in December, but persistent inflation has now reduced that to just 1. Despite the favorable CPI inflation report, markets closed mixed, with the S&P and Nasdaq reaching record intraday highs. According to Michael Oliver, the founder of Momentum Structural Analysis, this is another sign that the US stock market is in a bubble and heading for a dot-com bubble-style crash that will force investors to hurriedly exit stocks and diversify into precious metals. In contrast, Oliver predicts rate cuts will be great for gold and bond yields, and even greater for silver and the mining sector, which Oliver expects will significantly outperform gold in what he describes as the second leg of the bull market. Oliver is particularly focused on silver, which is typically more volatile and offers substantially bigger returns compared to gold during bullish market conditions. Oliver predicts that investors will rush into the metals and commodities market after the stock market crash, leading to a multi-year bull market that will be quite favorable for silver prices. We will present clips from Oliver's recent interview with Ben Mumme on the Living Your Greatness YouTube channel. Please watch the video to the end for some insightful tips and golden investment advice from one of the industry's most respected personalities. Also, ensure you like this video, subscribe to the channel, and don't forget to drop your comments and observations in the comments section below. We appreciate the support and enjoy the video.
Gold's going up and it's going up dynamically, but silver just goes ballistic. And it did that in twice before in the history of the silver market over the last 50 years. In the last year, like in 2001, the gold market was bottoming around $250 an ounce after having been up to $850 in 1980. Okay, so 20 years later, it's at $250, basing. Silver was basing. Started a new bull trend. It didn't peak till 2011. We're talking 10, 11 years. So we're about that old, okay? And in that last year, silver went into an acceleration mode where not only could you just see it on the price chart, where gold just it started to explode as well, but silver just went almost off the page in the way that it behaved. And what we do is we measure the relationship between silver and gold, and also the gold miners and gold. And in this pullback that we've had, this range-bound situation since 2020, where we mucked around, and silver and miners actually staircased down while gold went sideways, they underperformed gold. So if you were a long-term gold investor and got in at the right spot, like February 2016, which is when we pounded the table, gold was $1,140, okay? And you've been sitting on your position, well, you got bored to death in the last 3 years in gold. But in the miners and silver, you actually gave back some good profits. But the action of not only the momentum of those markets has broken out to the upside, saying, okay, trading range over, we're going dynamic. But the relationship between silver and gold also broke out. So you could plot that technically, and the miners and gold. So as bad as they've been underperforming over the last 3 years, they've now shifted to outperform. So if you're deciding at this point to say, well, I need some position in that type of monetary metals, whether the metals themselves or the miners, we strongly suggest your emphasis should be silver and the miners. Gold's the mama, but gold's not going to perform percent-wise what silver and the gold and silver miners are going to do on a percentage gain. That's where I would be focused. In the explosion, we call it, a commodity explosion back in October 2020, Bloomberg was coming up off of its low, and it got to $70 and went to 140 early 2022. During that move, energy was one of the best performing sectors, oil, natural gas, okay, in terms of percent gain. And they're, a hefty component within that index. But everything went up then too. You could throw a dart at almost any commodity and it went up. So it wasn't based on specific fundamentals for that market. It was based on money flows going into an asset category. And it went into that category. Now, it didn't go with gold. Gold had already doubled by 2020. Well, the commodities didn't bottom until 2020, and then they exploded. But this time around, we suspect that other than energy will lead this. So energy will join in. I don't have any doubt of that, oil and natural gas. But I think the grains could shock people. And already by our metrics, tweets, as important as is the price of gasoline and you're pumping it into your car, everybody's all concerned about that. You get concerned about the price of the stuff on the grocery store shelf. It's got wheat in it or, whatever. And corn and beans look like they're close behind soybeans. And rice as well. It's another part of the world. It's the basic food stuff. So it looks like food commodities could be the more painful upside in this Bloomberg Commodity Index next wave up. And that's going to be painful for the average person, the family budget.
The 50-year petrodollar agreement between the US and Saudi Arabia expired on June 9th. This agreement, which was simply allowed to expire, established the US dollar's role as the preferred currency for crude oil transactions and made it the world's reserve currency. The petrodollar agreement has greatly benefited the US economy and helped cement its place as a global superpower. With this agreement now over, Saudi and other countries can officially accept other currencies for crude oil transactions, greatly reducing the global demand for dollars. This will hurt the US economy and financial markets, as many countries will soon begin to dump their excess dollars on us. Every economic boon the US has enjoyed over the past 50 years because of this agreement will be reversed, made even worse by the massive $34 trillion national debt. It will also adversely affect the US bond market, which is already showing troubling signs. When the agreement was signed, Saudi Arabia agreed to price its oil exports exclusively in US dollars and invest its surplus oil revenues in US Treasury bonds. With that over, Saudi is expected to begin dumping US bonds even faster than it has done over the past year. A crisis has become inevitable for the stock market, but not without the Fed printing even more recklessly to save the economy. Oliver forecasts that these inevitable events will be great for gold and silver prices.
So this Fed concern about, quote, inflation, as they narrowly define it, improperly defined it as far as I'm concerned, is they've seen it toned down, but our measurements of the Bloomberg Commodity Index say, no, it's starting again. The next leg up is beginning. It began a couple months ago. And it's not going to be explosive at the outset, but it's going to show itself. Probably well in this year, it'll show itself. Again, pinching people, day-to-day reality. And so the Fed's facing this issue, we're going to, quote, fight inflation, again, as they narrowly define it. And yet they have another mandate, which is the unemployment issue, which is getting bad quickly. In fact, it's been bad for 3 or 4 months, despite the top line number. When you look inside the employment data, it really is weak. It's all government employees, hospital home care workers, hospitality workers. It's not the basic core industry groups that's having growth in jobs. They're flat. And now we're starting to see downticks in job growth. And I think the Fed's going to try to respond to that, meaning this is what I think gold knows and knew for the past few years, is that when this bubble breaks, the Fed will come in and try to save it. They always do. 2001 to 2002, they printed money and they cut rates like hell. 2007 through 2009, they cut rates like crazy and printed money, QE, et cetera. This time they'll be faced with that other mandate, the unemployment issue, which is contrary to their tightening of, quote, inflation. Well, the ECB just cut rates today. That's one of the team members, Federal Reserve, ECB, and the Bank of Japan. They cut rates. And I think probably after tomorrow's report on unemployment, they might find some data points there that they could say, now we have justification to begin to cut rates. And that is indicating to me that they're concerned about what's coming. That's why they cut rates. Anyway, I think this stuff's going to hit the fan this year.
Do you believe that we are in the biggest stock market bubble in history?
Yeah. No, it is. You measured by number of years up. And 2, the percentage gain from the bear low. And so we're like triple the age of the other ones and quintuple most of their gains, okay, of those comparable bull markets that we, in hindsight, call bubbles, right? .com bubble. It doesn't compare to what we've got now. And now we've got a market, if you want to talk markets, the stock market's being led by the front end symbols in S&P 500 and the NASDAQ 100, for example, where 5 or so stocks constitute 30-40% of the index. All the rest of them don't matter. And that's narrowed and narrowed and narrowed. Now you got NVIDIA. Used to be there was like 7 or 8 that did pretty well. And now most of those former leader stocks are just sort of floundering. They're not breaking down, but they're certainly not exploding. And we've narrowed the leadership down to NVIDIA, which is like a bubble stock. Not that it's invalid, not that their notions of the future of AI are invalid. It's just that they price themselves off the page into the realm of uncertainty. And when that happens and something turns down, it often finds no support because nobody knows where the hell to buy it. They've already bought it, And so you get crash-like events. And anyway, that'll be a factor that we're watching. But in general, there's so many attributes to this stock market that say, nah, don't count on this lasting. And when it turns down, it will be painful. That when you get into a panic downside, there's certain asset categories that the Fed doesn't want to go down, stock market being one, although they'll never admit that. But their history proves it's the case. When that thing goes down, you get real world effects, like unemployment data really starts to jump up bad. Other data points start to industrial production, so forth and so on. They tend to follow the market down. When that happens, the Fed will go the other way. So the last couple of years of relative tightening will reverse. They'll have to. Otherwise, they'll have a panic.
Between 1972 and 1974, silver underperformed gold by 2 years, but staged a furious catch-up rally in 74, surging by around 125%. Between late 73 and early 74. This rally marked the end of the first leg of the great bull market of the 1970s. In more recent times, silver lagged gold again for a few years before quickly staging a similar catch-up rally in the summer of 2020. Silver prices increased by almost 150% in 4 months. Oliver expects a similar performance in the next leg of the metals bull market, forecasting that silver will post 3-digit percentage gains in a very short period. Please share your thoughts on Michael Oliver's interview in the comments below. Also, ensure you smash the like button, subscribe for more exciting content on precious metals, and check out our other videos. Thanks for watching our videos.